All right, good morning. Thanks so much for joining us today. I'm honored to present the US forecast. So our forecast is for robust economic growth and recovery following what I think we all can agree has been a fairly dreadful year. Our plan for today is to talk about GDP, so output, followed by unemployment, inflation, housing markets, and finally a note on rebuilding the American economy. In terms of GDP, we're forecasting that 2021 will be a year of near record economic growth. It's actually going to be one of the years of highest growth we've had since the 1980s. And this is following the worst economic decline in the last 60 years. You can see that in 2020, we had a decline of 3.5% in output. We're expecting output GDP to grow by 6.3% in 2021, 4.6% in 2022, and 2.7% in 2023. There are upside risks to this. So this might, what might actually happen might be better than what we're showing on this slide, in part because vaccinations are ramping up and occurring faster than we had anticipated when we developed this forecast. So the latest news was that the US has secured 100 million doses of the J&J vaccine. This is the one-shot vaccine. The pulling forward of vaccinations with those who want to be vaccinated being able to be vaccinated sooner will mean that economic growth is likely to be a bit higher. Second, when we initially did this forecast, we had assumed that the 1.9 trillion American Rescue Plan that just passed in the Senate and is going to be signed by Biden this week, that instead of 1.9, it was going to be negotiated down to 1.5. And so what passed was 1.9. That should also mean that we get slightly faster economic growth. There's also a downside risk, which is as states begin reopening, even without mass vaccinations, as states rescind mask mandates, it's possible that we might have a resurgence of the pandemic, and that would put a damper on some of these growth numbers. But our view is that the upside risks are much more likely. And so the growth that we get might actually be higher than this very optimistic forecast that we're already showing. On a quarter by quarter basis, we see economic growth accelerating right now into the second and third quarters of this year. So this is when growth will really pick up to 7.4% on an annualized rate in the second quarter, all the way up to almost 9%, 8.9% in the third quarter of this year. And then we'll actually come back to trend, slowly declining to rates of 4.5%, which are still historically very fast, 4.1%, and then down into the 2s and 3%. This will get us back to the 2019 peak where we were before the pandemic by the second quarter of this year of 2021. So by the second quarter, we will be back where we were before the pandemic began in terms of economic output. It'll take us a little bit longer to recover in terms of employment. And then we forecast that we'll be back to prior trends by the first quarter of 2022. And then thereafter, we'll grow slightly above the trend that we had been following prior to the pandemic. One of the drivers of this growth is pent-up savings. So Americans normally save about $1.2 trillion every year. On top of that, Americans have saved an additional $1.8 trillion. This has a lot to do with the fact that we weren't able to go out and spend and consume as we normally do, but it also has to do with the additional fiscal relief packages that were passed earlier last year. So the CARES Act, the additional $908 billion relief package passed in December. That's what's included in this chart. What's not yet included is any savings that arise from the 1.9 trillion that we expect Biden to sign into law this week. So savings is very high. We expect much of the savings to be spent down over the course of 2021 and 2022. Where we expect a lot of growth is in services. So things like healthcare consumption as people resume healthcare visits and preventive care, food and restaurants, recreation, entertainment, travel. And so we're forecasting that services growth is really going to speed up right now in the second and third quarters, and then asymptote back to the trends from prior to the pandemic. On the reverse side, we had been consuming a lot of goods while we've been under this pandemic, and we expect that as well to go back to trends. So less consumption of all the fitness equipment, all the home office equipment, all those purchases that we did over the course of the pandemic. Focusing in more detail on services consumption, what this graph is showing is the decline in consumption for a particular sector relative to its 2019 peak. And so here, what you have is that we're down about $500 billion in the second quarter of 2020 during the peak of the shutdown. And then as the shutdown eased, you see that healthcare spending bounced back somewhat, but we were still down relative to 2019 levels. And then now our forecast is that healthcare spending, healthcare consumption will resume, and we will be back to being above the 2019 level by the third quarter into the fourth quarter of 2021. So this is showing it for healthcare, the blue bars. In terms of food and recreation, we expect that to, food and accommodation and recreation, we expect those elements of consumption to recover by 2022. And then the last pieces of consumption that we expect to recover are transportation. This is related to people commuting less as they're able to work more from home, even after the pandemic wanes. And then education and social services associated with people consuming less childcare until long after the pandemic wanes. And we see women returning into the labor force at rates that had existed prior to the pandemic. Focusing on unemployment. Right now, we're right about 6.1% unemployment rate on average for the first quarter of 2021. Our forecast is that this will decline to 5.2% by the end of this year, 4.1% by the end of 2022. And then finally, by the end of 2023, we'll be back at around 3.7%, which is the same level that we were at right before the pandemic. So it will take a while for unemployment to recover. The reason for that is even though the economy will be rebounding and there will be a lot of job growth, there are a lot of people who also left the labor market who don't currently count as being unemployed. As these people start coming back into the labor market, we expect them to start pushing the unemployment rate back up. And so there's these two countervailing forces. Economic growth is causing unemployment to decline. People are seeing more employment opportunities. They're going back into the labor force. That's pushing unemployment back up. The net effect is to slow the rate at which unemployment improves. On the right-hand side, you can see that currently labor force participation is as low as it was in 1976. This is related to a lot of women leaving the labor market to take care of homeschooling. And so we are back at levels, especially for women, of labor force participation as existed, really into the early 1980s. In terms of total employment, we expect payroll employment growth will accelerate right now starting in Q2, adding about 500,000 jobs per month through the middle of next year. The February jobs number was that we added just under 400,000, so we expect the rate of growth to really pick up. That will get us back to the pre-pandemic level of employment, really by the end of 2022. We won't really get back to trend even by the end of 2023. We'll still be missing 5 million jobs from where we would have been if the pandemic had not occurred. This is related to a lot of people who left the labor force at around age 62, 63, prior to retirement, taking early retirement, now not being able to, to be rehired very easily. And so we expect a portion of the population to really never come back into the labor market. Focusing on inflation, we just got inflation numbers this morning. They were about 1.7% at an annualized rate. And so that helps affirm some of the inflation forecast that I'll be showing you. We expect core PCE, this is personal consumption expenditure inflation, will accelerate temporarily above 2% by 2022. But then we expect it to come back down to around 1.9%. This is what the Federal Reserve uses when it sets interest rate policy. And so because we don't expect a burst of high inflation, we only expect a temporary, tick up of inflation above 2% into 2022, and then coming back down thereafter. We really don't expect the Federal Reserve to start increasing interest rates until late into 2023, possibly into 2024. For the prices that you and I see in the supermarket, this is the core CPI. We expect inflation to run around 2.3 to 2.2% once the economy is fully revved up and going in 2022 and 2023. That's about similar to rates that we saw in other parts of the past decade. Turning to housing markets, we had a 15.2% increase in home prices between the end of 2019 and the end of 2020. You can see that this is higher than the price appreciation we had in any one year during the height of the housing boom. But we expect that this 15.2% increase in home prices over this past year has pulled forward much of the appreciation that would have otherwise occurred. And as people start putting their homes onto the market once the pandemic wanes, as people feel more comfortable having open houses, showing their homes, we expect home price appreciation to subside down to 3.7% in 2021. This is fourth quarter over fourth quarter, 5.4% in 2022, 3.7% in 2023. So not the same levels of home price appreciation that we saw during the recovery from the great financial crisis, something much more muted, given that we've already had such high price appreciation over the course of the past year. Housing construction will really be taking off to take advantage of the currently high home prices. And so our forecast is that we're going to have about 1.7 million housing units built in the US over this year. And then that will start coming down to around 1.6 and 1.5 million units. So we're going to get back to trend level by the end of 2023. Housing construction and residential fixed investment in general. So residential fixed investment is going to include things like home repairs, home renovations. We're currently having sales of existing homes of above 6.5 million, about 1 million more than we had in prior years. And so that's a lot of home turnover. And with that is associated a lot of home renovations and home repairs. And so we expect residential fixed investment to be above trend through the end of our forecast period. There are two things that are driving above trend for GDP growth. We talked about consumption going back to trend, so it's not going to be consumption. It's really residential fixed investment. That's this first piece that we're showing you. And the second piece is the replenishment of business inventories. Businesses depleted inventories over the course of the pandemic. We expect them to build these inventories back up right now as the economy improves to be able to take advantage of consumption that's returning back to trend. The last piece I want to talk about is US potential GDP. So what you see here, all of these blue lines, are forecasts for what GDP would have been at different periods in time. In 2005, we thought that by 2016, our GDP level would be up here. And then gradually, after the Great Recession, we thought that GDP was going to be lower. And then again, we thought that GDP was going to be lower in 2015. And then now in 2021, the Congressional Budget Office has again reduced its estimate of potential GDP. So there's been a lot of discussion, and one of my colleagues at Lemur is going to talk about the output gap, but the output gap is being measured relative to some theoretical potential. And right now that potential seems, has been essentially brought down from what from what could be possible. And a lot of the stimulus, the release of pent-up savings is going to test whether it's possible to go above potential GDP, this measure of potential GDP, and get to some higher potential, some higher level. Is it possible for our economy to do more? In 2015, so right back here, in 2015, the Federal Reserve started increasing interest rates following the Great Financial Crisis, even though unemployment was at 5%, and with a Black unemployment rate of about 10%, and even though inflation was only 1.2%. And it did that preemptively in an attempt to prevent potential future inflation. Right now, the Fed Reserve is committed to not increasing interest rates until we actually see inflation occurring. So not in anticipation of inflation, not just because the labor market is beginning to tighten, only once we actually have evidence that we're having sustained high inflation. And we don't expect that to happen for a sustained period of time in the coming years. And so our forecast is that we're going to go above estimates of potential GDP. It's really going to be a test of whether or not our economy can handle going above potential without generating sustained inflation. If it's the case that we get to have GDP above potential, it means we've been underestimating the potential of our economy for really the past decade. And we've perhaps mistakenly bought into this notion of secular stagnation when the reality is that the economy could have been growing much faster. So we're about to put that to the test in these coming years. Thank you very much. That's my forecast presentation.